Hello, how are you all? I'm Dr. Labib from Dr. Labib Academy. Welcome you all. Today we are going to have on ACCA, it is with respect to financial management. Is a section A. It is the continuation of what? The continuation of business valuations. Is it right? The continuation of business valuation. This is in the series of 10. Okay. This is in the series of 10. Last class we have done with respect to till 142. Okay. This is with continuation of the things which we have started with the business valuation. Okay. Section A. We'll continue and we'll complete today. And coming to the point, please subscribe to my channel, share this channel, watch till the end. Your feedbacks are very important, okay? And if it really makes valuable, just like the channel, please subscribe to my channel and share the channel so that we can reach as much as possible. Okay, people should get benefit. This is with respect to the section A, okay? This is respect to section A, business valuations. Okay, business we are going to complete the section A for all the lectures, maybe by next class, next session. Okay, coming back to this, what they said: asset-based valuation, business valuation, based on the assets using an net realizable value, are useful in which of the following situation? Means asset-based valuation means where we are using the assets to value the business, to value the firms. Okay, they are given 4 different options. What are the first option? When the company is being bought for the earnings to cash flows, is it that all the assets can produce in the future? When we say it is earnings to cash flow, is it right? It is earnings to cash flow. We are talking in terms what? In terms of price earning ratio method. Is it right? It is not net realizable method. Okay. Asset based valuation using NRV are useful in which of the following situation? This is useful. This is used in where it is not net realizable value but price earning ratio method. Fine. And second one. For asset stripping, see what happened whenever we are making the asset strippings. What we value is that we value the assets. Is that we value the assets, by dividing it to the smallest. But we are segregating. Is it right? We are making it each individual asset. Is it individual asset? Net realizable, okay, net realizable value. Is it net realizable value? Fine, we'll see the things. To identify the maximum price, okay, to identify a maximum price in a takeover. Is that when we are talking about the asset-based asset-based measures, net realizable maximum price, is it right? It is not to identify the maximum price, is right? When you are talking about the asset-based valuation in terms of takeover, we will take which price? We will take minimum price but not maximum price. Okay, we'll take minimum price but not maximum price. When the company has a highly skilled, we never ever come across a valuation based on the workforce. Okay, we never, when a company has, this would not be reflected in the assets, is it right? This will not be reflected in assets. The correct answer is what? We have to divide the assets into broken parts, into small individual assets, and based on that we have to calculate the net realizable value. Fine, that is what it is. Now what for a company? Let EPS, price per share is nothing but market price per share. Okay, market price per share. value per share, okay, market price per share, value per share, earnings yield, is right. See, make it a point, earnings is yield is nothing but reciprocal of price earning ratio, is right. Earnings is nothing but the ratio. What is the price earning ratio? Price earning ratio is MPS divided by EPS. Reciprocal is nothing but EPS divided by MPS, okay, EPS divided by MPS, and total earning. Which of the following is the best expression of the value of the company? Is that one by one total earnings? Earnings yield is nothing but total earnings. We are talking about the value. Value is nothing but total earnings. Is it right? Total earnings times 1 divided by earnings yield. Is it right? 1 divided by reciprocal of the total. We are talking in terms of total earnings. Here earning per share. Here talking about, when we are talking about this, we are earning per share. We are not talking about value of the company. Is it right? We are talking about earning per share. If you take earning per share, what we'll get? We'll get value per share. Is it right? Value per share. EPS divided by market price per share. It is nothing but earnings yield. Is it right? It is nothing but earnings yield. Yeah, PPS divided by price per share divided by earning per share. It is nothing but price earning ratio. We are talking about the total earnings. Total earnings times 1 divided by earnings yield. When you take these things, we will get what? We will get value of the company. We have to take into consideration that the total part what it is going to be done. A company has just paid an ordinary share dividend. Is that they have paid an ordinary share dividend. How much they have paid ordinary share dividend? They paid just paid, okay? Means it is going to be D0. Is it right? It is going to be D0 and is expected to pay dividends in 1 year's time. This is going to be D1. The company cost of equity KE is how much? KE is 13%. What they are asking us, what is the market price of company share on X dividend basis? First, you have to take into consideration how we have to take into consideration. If you take the market value is I will say X dividend basis. Is it? What is the market price of company share? Market price of the company's share. Is it right? What we have to do? D1 divided by KE minus G. Is it? They have D1. Is it right? How much is the D1? 33.6. Is it? D1 is given how much? D1 is 33.6 cents. Okay. Next, K is how much? 0.13. We don't know G. Okay. We don't know G. G will, how we have to calculate G? What is the dividend there? D1 divided by D0. Okay. D1 divided by D0. How much it will come? Is it right? Minus 1. Okay. Minus 1. How much is D1? D1 is 33.6 divided by 32.0. Is it? 33.6 divided by 32. Okay. Minus 1. It comes to how much? It comes to 0.05. Now you put the things here. Okay. 33.6 divided by 0.13, 0.05. Find how much you will get. 33.6 divided by 0.08. Is it? 4 420 cents, okay, or $4.20. If you take dollars, 4.20, okay, 4.20. Next, Toggle has an issue of how much? See, make it a point. 6% loan notes redeemable at 100. Alternatively, each loan can be converted into 30 ordinary shares. The current ordinary shares of Toggle is how much? 350, and they going to grow at the rate of 4% per annum. What they are saying, there is a pre-tax cost of debt is 5%. What is the current market value of each 100 convertible note? Is it current market value of 100 convertible note as such? Fine? No. What we are saying that it is redeemable in 3 years time, okay? It is going to be redeemable in 3 years time. Now if that is the case, fine, expected share price, is it? First we have to calculate what is the share price in 3 years time, okay? What is the share price in 3 years time as such? How much is the current price? The current ordinary share is how much? Current price is how much? P0 times, is it right? T period times. What is the growth? Growth is how much? Growth is 4%, okay? Growth is 4% to the power of how much? To the power of 3. Is it right? To the power of how much is there? 3.5, 1.04 to the power of 3. Is it right? To the power of 3. It comes to how much? 3.5. 3.5 is the share price times 1.04 to the power of 3. It comes to 3.937, okay? 3.937. Okay, now how much conversion we are making? This is the expected share value, is it right? What is the how many shares we are getting? We are getting 30 shares, is it right? Conversion value is it right? Share price into number of shares. Is it right? Share price is how much? 3.94 times 30. Is it right? 3.94 times 30. It comes to how much? It comes to 118.20. Okay, now see what happened. We have to compare. Is a compare. See, if you redeem, is it right? If redeem, is it right? If redeem, how much you will get? You will get $100. Is it right? You will get how much? If you make a conversion, is it right? If you make a conversion, how much you will get? 118.2. Okay, we'll get how much? 118.2. Fine. Now what we have to know? We have to calculate the market value. Is it right? We have to calculate the what is the market value of 100 convertible loan notes. Is it right? Market value of 100 convertible loan note. Please subscribe to my channel, and I am following Kaplan Publishing, Kaplan Exam Kit. Okay. Now what happens? See how much they are getting. Coupon is how much? 6%. Is it right? Coupon is how much? 6% on 10. Means every year how much they are getting? They are getting 6. Is it right? This is right. This is for the coupon. Is it right? This is for the coupon. Every year they are getting how much? 6. And it will be for how many years? It will be for 3 years. Is it right? It will be for 3 years. How much is there? It will be for means $6 at the rate of Is it right? At the rate of 5%, at the rate of 5% for 3 years. Is it right? How much you will get? $6 times. If you take the annuity value, okay, annuity value table, if you take at the rate of 5% for 3 years, it comes to how much? 2.723. Is that 2.726 into 2.723? It will be how much? It will be 16.338. Now we have to have the principal. How much is the conversion value? Conversion value will be how much? 118.2. Is it? This is the conversion value. We have to discount it. Is it 118.20 at the rate of how much? At the rate of 5%. Present value table. Okay, present value table. It comes to how much? $118.20 times 0.864. okay, at the rate of 5% for third year. Okay, for third year it comes to how much? 118.2 times 0.864. Is it right? It comes to how much? 102.12125. okay, 10.125 plus 16.338. Is it right? 16.38. It comes to how much? 118.46. This is the current value of, this is the current market value of each convertible bond. Okay, loan note. How much? 118.46. Now, the owners of the private company, which was disposed of the entire investment in the company. The company has an issued share capital of 1 million of 50. Means number of shares will be how much? Number of shares will be how much? 1 million. Is it right? 1 million divided by 0.5 means 2 million shares. Okay. The owners have made the following valuations: net current assets, net current liabilities, current liabilities. The net realizable value of current assets exceed the book assets means 5. Means you have to add this. The current assets includes 2 million of the accounts receivable which are thought to be irrecoverable. We have to reduce this. Okay, we have to reduce it. Now what will happen? You take non-current assets. Okay, non-current assets. How much? 30 million. Okay, current assets. Right, current assets. How much? 18 million. Okay, 18 million. Next you have excess. Okay, excess NRV. Okay, of NRV of current assets. Is it right? NRV of current assets will be how much? 4 million. Is it right? Next you have to minus it. Is it right? You have to the receivables. Is it right? Accounts receivables. Accounts receivables, non-recoverable, irrecoverable. Okay, irrecoverable. How much is there? Irrecoverable accounts is 2 million. Okay, next we have non-current liabilities. How much? 12 million. Okay, we have current liabilities. How much? 10 million. Okay, how much you will get? 48.52. Okay, 38 plus 48.52. 50, 38, 28. Okay, how much you are getting? You are getting how much? We are getting how much? We will get 28. Okay, we are getting how much? 28 million. Fine. Now what they are asking you? Minimum price. Okay, they are asking you minimum price. Minimum price is nothing but this is the value. Okay, this is the this is the net realizable value. Okay, this is the net realizable value. How much is it? 28 million divided by number of shares are how much? 2 million shares. It comes to how much? It comes to 14. How much? It is going to be how much? 14 per share. Likewise you have to do. Okay, likewise. Next, a company has an annual after tax operating cash flow is how much? 2 million, which are expected to continue in perpetuity. What is the formula for perpetuity? Is that perpetuity formula is C divided by R. Okay, if there is a growth, then we have to add. The company has a cost of equity is 10%, before tax cost of debt is 5, and after tax weighted average cost of capital is how much? 8%. Corporation, we don't need all those things, is it right? We should make it a point that it is we have to take weighted average cost of capital. It is otherwise called as R. Cash flow is how much? Cash flow is 2 million. Okay, and weighted R is how much? R is 0.08. 2 divided by 0.08. It comes to how much? It comes to 25 million. Lane has issue, and Lane company has in issue 3% convertible loan note, which are redeemable in 5 years time. What is the nominal value? 100. Alternative, each loan can be converted into 25 Lane ordinary share. The current price is how much? This we have done just now. Okay, the current price Lane is 3.6, and the future share price growth is expected to grow is how much? 5% per share. The before tax cost of debt is 10%. Corporation tax is how much? Corporation tax is 30%. How many we are converting it to how many share? One loan note is going to be converted to 25. See what we have to do? You have to make a conversion. Is that you have to make a conversion value. What is the conversion value? What is the current price? Current price is what? PO 1 plus PO 1 plus G to the power of n. Okay, time. Okay, fine. We have to. This is we are getting conversion value into number of shares. PO price, current price is how much? Current price is 3.60. 1 point. What is the growth they have mentioned? Growth is 1.05. Is it right? 1.05. How much? How many years they have mentioned this? 5 years time. Okay, 5 years time. Fine. Times 25 shares. That 3.6 times 1.05 to the power of 5. Okay, to the power of 5 times 25. It comes to how much? It comes to 114.86. 114.8686. Okay, now fine. Now we have to, what we have to do? We have to discount the loan notes. Is that if you are converting, how much you'll get? This. Now we in order to know the market value, shortcut method, is it right? Market value already we have done. First you have to take the coupon. Is it right? How much is the coupon amount? Coupon amount is how much? 3. Is it right? It comes to how much? $3. 3 coupon amount is 100 times 3 by 100. Okay, it comes to how much? $3. Is that times 5 years? Is that at what rate we have to take? We have to take at the rate of 10%. Okay, we have to take at the what is before tax cost of debt? 10%. Fine. At the rate of 10%, annuity value for 5 years. Okay, 5 years. It comes to how much? It comes to $3 times 3.791. Okay, 3 times 3.791, it comes to how much? It comes to 11.373. Okay, now we have to take the conversion value. Yeah, we have to take the conversion value. How much is the conversion value? 114.86. Is it right? 114.86. Discount factor at the rate of 10% for 50 years. Okay, for 50 years. It comes to how much? 114.86 times 0.621. It comes to, you take into consideration 114.86 times 0.621. Is that 71.328? Okay, 71.328 plus 11.373. It comes to how much? It comes to 82.70. 82.7 approximately, nearest one. Okay, fine. Next, okay, we will complete these two, and subsequently we will start risk management in our next last one. Okay, indicate by clicking on the relevant boxes whether the following statements are true or false in respect to business value. The earnings yield method. What is the earning yield? Earning yield is nothing but reciprocal. Okay, this is the reciprocal of price earning ratio. Okay, this is the and the dividend growth model. Both are different. Is it right? Earnings yield is based on the price earning. Dividend growth model is based on what? Dividend D1. Is it right? It is based on what? D1 1 plus G. Is it right? KE minus G. Okay, it is the should give similar values. No, it will not give similar values. Both are different. Market capitalization represents the maximum value for the company. Okay, market, you see, there is nothing like a maximum value. Is it right? They will give the current value. Okay, market capitalization is nothing but market price per share into number of shares. They will give what is the current value. They will never say it is the maximum value. Is okay? It is false. The price earning ratio is the reciprocal. See, reciprocal of earning yield. That's what we have done. Is it right? This is true. The price earning should be increased if the company being valued is riskier. See, price earning ratio will be in the times. It is, whereas company valuation is riskier in the valuing the company. Both are different. Okay, this is based on the earnings and this is based on the risk. Fine. In relation to capital markets, which of the following statements are true? The return from investing in larger companies has been shown to be greater than the average returns of all companies. In relation to capital market, the return from investing in larger companies has been shown greater than it is shown greater. See, investing in the larger. We'll see what are the weak form efficiency arise when investors tend not to make rational investment decisions. There we are talking about which one is true. Is it right? See, weak form of efficiency talks about what? Weak form of efficiency talks about the past prices. Is it right? When investors tend not to make rational investment decisions. Allocative efficiency means that transaction costs are kept minimum. That allocative efficiency is in terms of the diversifications. Is it right? In terms of the diversification, we are not going to take that into consideration. It is not at the minimum. Is that research has shown that over time share prices appear to follow a random walk. Is it? This is the research. What is a random walk? Random walk is nothing but it will go. Maybe it will go up, it will go down. We dare not predict. Is it right? Past we cannot have the same trend. Past prices will not follow the future prices. Is it right? It's future prices. As simple. You see the graph of any share. Okay, it will never be linear. Okay, it will never be linear on the upside, nor it will be linear on the downside. Always it will be, if you take into consideration this is linear. Okay, it will always be a non-linear. Is always randomly. Sometimes it will go up, sometimes it will come down. Is that how it moves? As simple as that. Okay, so, okay, fine. It will go up, but it will not go up, but it will go up with some variation. Is it right? This is of all the things. This is the research has shown that over time share prices appear to follow a random. Is that? With this we have completed business valuation. We have completed, so which one? We have completed financial management functions. Is that? We have completed financial management functions. See, you go by the sequence. Okay, you go by the sequence. We have completed financial management function. We have completed the environment. Is it right? We have completed the environment. We have completed the working capital management. Fine. We have completed the working capital management, and most importantly, what we have done, we have done business finance. Is it right? Business finance and cost of capital, cost of COC. Okay, we have completed cost of capital, and this one is we have done business valuations. Is it? We have done 1, 2, 3, 4, 5, and the last one is we will cover the risk management in our next session. Thank you so much. Best of luck. Please subscribe to my channel, share the channel, and write your comments. Is that how best we can improve in the next session? Thank you.